Welcome to this morning's high-powered market explainer. Look, if you're trading the markets today, you already know we've just had an incredibly volatile 24 hours. Our goal right now is to connect those overnight geopolitical shocks directly to the actionable technical setups you're going to need before the opening bell rings. We are diving into the hard data, the critical levels, and the fundamental drivers, so let's just get right into it.
Here is exactly what we're looking at on today's agenda. First, geopolitical shocks and flashpoints. Second, global markets go risk-off. Third, today's macro event radar. Fourth, major currency technical setups. And finally, USD/INR and Nifty technicals.
Let's kick things off with Section 1, geopolitical shocks and flashpoints.
So, diplomatic gridlock is basically what's driving the market's anxiety right now. Hopes for a U.S.-Iran breakthrough, they've completely dimmed at this point. As Iran's Foreign Minister Abbas Araghchi just noted, the path to an agreement is completely backed up. He literally said it resembles a traffic jam way more than a highway. Tehran is actively defending its recent strikes in the Gulf, calling it self-defense, and they are firmly reiterating their demands. They want sanctions relief, they want access to frozen oil revenues, and the total removal of restrictions on crude exports. Meanwhile, the U.S. side is stepping up, demanding the immediate reopening of the Strait of Hormuz the second any agreement is reached. So technically, diplomacy is open, but practically, it is totally stalled out.
And there's this massive disconnect right now between the political corridors and the actual reality on the ground. Over in Washington, the U.S. House just passed a rare war powers resolution. This really reflects a growing bipartisan unease as they try to limit any further military action. But physically, on the ground, the escalation is absolutely accelerating. We've seen Iranian strikes recently target U.S.-linked facilities in both Bahrain and Kuwait, with that Kuwait airport attack tragically causing casualties. So while Congress is back home flexing its constitutional muscles, we are watching a highly volatile flashpoint develop in real time.
Moving right along to Section 2, global markets go risk-off.
All of this geopolitical adrenaline triggered a massive risk-off rotation overnight, abruptly slamming the brakes on Wall Street's really impressive winning streak. The Dow plummeted over 600 points, the S&P 500 was down 0.75%, and the Nasdaq dropped 0.9%. Naturally, safe haven demand boosted the dollar index right up to 99.53 as its major peers just weakened across the board. Energy markets are nervously checking their pulse today, with disrupted flows in the Strait of Hormuz, keeping Brent crude hovering right near $97 a barrel. But here is a really crucial point you need to catch. Gold actually slipped. Why? Because investors are getting increasingly terrified that this energy-driven inflation is going to force central banks to keep rates higher for longer.
Which brings us to Section 3, today's macro event radar.
You're definitely going to want to keep your radar tuned to this watch list today. We have ECB President Christine Lagarde and Bank of England Governor Andrew Bailey both speaking, and you can absolutely expect them to address these fresh inflation fears. We've also got U.S. jobless claims and labor cost data dropping. Now, for the Indian markets, anticipation is really building for tomorrow's crucial RBI policy decision. This is all happening right alongside rumors that New Delhi might announce some bond tax relief, which could provide a much-needed lifeline for foreign capital inflows. Okay, let's get into the charts. Section 4, major currency technical setups.
Let's start with the king dollar. The U.S. dollar index, the DXY, is currently playing out as a buy-on-dip setup, clearly gaining ground on all this Middle East uncertainty. But the real catalyst is under the hood. The headline ISM Services PMI just printed a surprisingly robust 54.5. That beats estimates, and it acts as a stagflationary engine. That whole higher-for-longer rate narrative we just talked about, it just got a fresh injection of adrenaline. Support is sitting very solidly at 99.00, with immediate resistance up at 99.64. So trade the dips here, but definitely do it with caution.
Over in Europe, the picture's pretty bleak, honestly. EUR/USD has fallen below key support, and its structure remains a very clear sell-on rise. The final composite PMI was just revised down to 48.5. That is an 18-month low, marking the second consecutive month of contraction. With Lagarde speaking today and those geopolitical risks weighing so heavily, you need to watch for resistance at 1.1612 and then 1.1634. If the pair pushes up there, sellers are very likely going to step right in. Downside support is resting at 1.1544. Moving over to the British pound, GBP/USD was just firmly rejected from its 50-week moving average. This is also a sell-on rise setup for sure. Remember, the UK is a high beta energy shock economy, so spiking yields from the Middle East tension are seriously bruising this pair. But the real fundamental damage here? The UK services PMI, literally the absolute engine of the British economy, cracked below that critical 50 mark to land at 49.3. Immediate resistance is right at 1.3450, with support targets cascading down to 1.3393 and then 1.3326.
And then, of course, there's the yen. USD JPY is currently flirting with the highly politically and economically sensitive 160 handle. Technically speaking, the setup is a buy on dips, with supports at 159.77 and 158.93. But guys, I cannot stress this enough. Tread with extreme caution here. We are dancing right around that 160 mark, and intervention risks from Japanese authorities are very, very real right now. Plus, markets are currently pricing in a 78% probability of a Bank of Japan rate hike at their June meeting. This pair is basically a coiled spring.
Finally, let's wrap up with Section 5, USD/INR and Nifty Technicals. The mechanics of yesterday's USD-INR session perfectly demonstrated just how fragile the rupee is right now. It basically played out in 4 distinct steps. Step 1, Middle East tensions pushed crude higher. Step 2, the rupee instantly felt the heat, weakening to a one-week low of 95.78. Step 3, things got so volatile that state-run banks had to step in and aggressively intervene on behalf of the RBI, selling dollars to curb the bleeding. And finally, Step 4, those banks executed dollar-rupee buy-sell swaps, which pushed the one-year implied yield down 5 basis points to 2.99%. It was an incredibly heavy defense day.
So what does that actually mean for your levels today? Well, for USD/INR traders, 95.81 is your absolute line in the sand. If escalating oil prices push us to break above 95.81, it's going to invite a wave of aggressive bearishness for the rupee, potentially testing resistance all the way up at 96.18. You want to keep a very close eye on the support floors at 95.43 and 95.21.
Over in the equity space, the Nifty 50 slipped 78 points to settle at 23,406. Now this marks its 5th decline in just 6 sessions. Early in the day, we actually saw some short covering on those hopes of foreign bond tax relief from the government that we talked about earlier, but that optimism was completely overwhelmed by 2 major sudden shocks that brought the index crashing down to this level.
Here are the exact 2 shocks that crushed that momentum. First, the geopolitical hit. We had fresh reports of strikes on Iran's Qeshm Island, pushing Brent crude toward that $96 mark and really bruising broad market sentiment. But the truly violent move was sector-specific. A critical note from Jefferies questioning the timeline of LTM-Mindtree's AI revenue growth triggered massive profit booking across the entire IT cohort. The IT index crashed nearly 5%, 4.98% to be exact, completely reversing a sharp rally from early June.
Taking all of that into account, the Nifty's technical structure remains a very clear sell on rise. Immediate resistance sits right above us at 23,439, followed by 23,576. If we see any intraday pops, sellers are very likely waiting right there. On the downside, you need to watch the support levels cascading from 23,260 all the way down to 22,928. It's on a very tight leash right now. Which brings us to our final thought for the morning. With crude energy shocks currently testing major technical supports across the board, and that high-stakes RBI policy decision dropping tomorrow, you really have to ask yourself, are you properly positioned for the next macro catalyst? Because given this traffic jam in Middle East diplomacy, the stagflationary data we're seeing globally, and central banks on high alert everywhere, volatility is literally the only guarantee we have right now. Stay incredibly alert today, respect your levels, and trade safely. Thanks for joining me on this explainer, and I'll see you next time.